If you're planning to smash out your tax return in the first week of July, stop. The ATO has said this outright. Lodging too early roughly doubles your chance of your return getting flagged as incorrect. And this year, there are genuine changes to what you can claim, what's being watched closest, and what shows up automatically on your return before you even touch it. I'm going through everything that's different for this year's return, exactly what the ATO's watching hardest, and what to check before you hit submit. Let's get into it. Quick reminder, I'm not your accountant. I'm not a registered tax agent. This is general information to help you understand what's changed, not personal advice for your specific return. If your situation's complex, multiple income sources, rental property, crypto, trusts, a registered tax agent is genuinely worth it this year more than most. Let's start with the ATO's own warning, because it's the one thing that applies to literally everyone.
Number 1. Timing. The ATO has been explicit about this. Lodging in the first days of July significantly increases your chance of making an error because your pre-fill data isn't fully ready yet. Here's what pre-fill actually is, for anyone who hasn't paid attention to this before. Your bank, your employer, your health insurer, and other institutions report information directly to the ATO, and that data gets automatically loaded into your return before you even start filling it in. For most people, this data isn't fully available until closer to the end of July. If you lodge before then, you're relying on your own memory and manual entry for things like bank interest, dividend income, and payments from other government agencies. And that's exactly where people forget things.
The ATO's own data shows the most common July mistakes are exactly this: forgetting a small amount of bank interest, missing dividend income, or leaving out a government payment simply because it wasn't visible yet and the person assumed their return was complete. What to actually do: check whether your employer has marked your income statement as tax ready in MyGov, and check whether your pre-filled data has populated before you lodge. If it hasn't, waiting 2 or 3 weeks costs you nothing and meaningfully reduces your chance of having to go back and amend later, which itself can trigger more scrutiny than getting it right the first time. Number 2, work from home deductions, which the ATO has named as one of its top 3 focus areas this year, for good reason. Millions of people claim this every year, and it's consistently one of the most commonly incorrect claims on the entire tax return. The fixed rate method for this financial year sits at 70 cents per hour worked from home. That rate is designed to cover a broad bundle of running costs: electricity, gas, internet, phone, and the decline in value of office equipment, all rolled into that single hourly figure. Here's the part that trips people up every single year, and it's genuinely the difference between a valid claim and a rejected one. You need a real, contemporaneous record of the actual hours you worked from home across the entire year. Not an estimate written up in October when you sit down to do your return, not roughly 4 days a week, most weeks. An actual record, a diary, a calendar, a spreadsheet, or a timesheet, kept as you go throughout the year. The ATO has said directly that copying and pasting last year's work from home claim without proper records this year is one of the fastest ways to trigger a please explain request. If you don't have a genuine hour-by-hour record, you generally can't use the fixed rate method at all. You'd need to fall back on the actual cost method instead, which requires full receipts and proper apportionment for every single expense, a much heavier burden of proof. What to actually do? If you've been tracking your hours properly all year, you're fine. Use the fixed rate method. If you haven't, this is worth a conversation with a tax agent before you lodge, rather than guessing and hoping. Number 3, and this is a big one: rental properties. The ATO's own data shows roughly 9 out of 10 rental property returns contain at least one error. That's not a small compliance gap, that's nearly universal, and it's exactly why this remains one of the ATO's top 3 focus areas year after year. The most common mistake is confusing repairs and maintenance with capital improvements. A genuine repair, fixing something that broke during the time you owned and rented the property, is generally deductible immediately in full. But an improvement, upgrading something to a better standard than it was before, or fixing a problem that already existed when you bought the property, isn't an immediate deduction. It has to be claimed over time through depreciation or capital works rules instead. This year specifically, there's a major new development worth knowing about.
The ATO has issued a formal ruling and new compliance guidelines specifically addressing holiday homes and mixed-use rental properties. If you own a property you also use personally and rent out the rest of the time, this ruling changes how the ATO assesses whether your ownership costs are deductible at all based on whether the property is genuinely held mainly to produce income or whether personal use outweighs that. And critically, this ruling doesn't just apply going forward, it can apply to income years both before and after it was issued, which means it can reach into your current return, not just future ones. What to actually do? Review your full year records carefully before lodging. Interest expenses, repairs versus improvements, borrowing costs, and if it applies to you, the split between personal and rental use of the property. Given how high the error rate is on rental returns generally, and how new and specific the holiday home guidance is this year, this is genuinely one of the strongest cases for using a registered tax agent rather than doing it yourself. Number 4, a handful of genuine changes to the rules themselves, separate from the ATO's compliance focus. First, donations. The old $2 minimum threshold for tax-deductible gifts has been removed. Previously, a donation needed to be at least $2 to claim as a deduction. Now, gifts to eligible deductible gift recipients are deductible regardless of the amount, however small. Second, if you incurred general interest charge or shortfall interest charge on or after July 1st, 2025, you can no longer claim that as a tax deduction on this return or any return going forward. If you're carrying any ATO debt, that interest is now a pure cost with nothing offsetting it. Third, trust distributions. If you're a beneficiary of a trust, your distribution statement now includes additional new information to help you report correctly, including new labels for managed investment scheme amounts, frank distribution details, and foreign source income. The ATO is also rolling out pre-fill for trust distributions this year, which should reduce errors, but it also means trustees need to lodge trust returns promptly, since your individual pre-fill depends on that trust information being available first. Fourth, quickly, vehicle expenses. If you use the cents per kilometre method for work-related car use, the rate is now 88 cents per kilometre, capped at 5,000 kilometres. If you're claiming for an electric vehicle you charge at home for work purposes, there's now a specific EV home charging rate, which is increasing from 4.2 cents per kilometre to 5.47 cents per kilometre from the start of the next financial year. And one important correction, if you've heard about this elsewhere, the new $1,000 instant work-related deduction is not available on the return you're about to lodge. It doesn't begin until the 2026 to 27 financial year, meaning it will first show up on returns lodged in 2027. Applying it to this year's return would be a genuine mistake, not a shortcut. And finally, the broader theme running through everything this year, the ATO's data matching capability keeps expanding, now reaching across banks, employers, share registries, digital platforms, cryptocurrency exchanges, and government agencies simultaneously, with increasing use of AI to flag inconsistencies automatically, sometimes before a return is even fully processed. The practical implication is straightforward, even if it's not exciting. The safest approach really is the boring one. Declare everything, claim only what you can properly substantiate, and keep real records as you go rather than reconstructing them later. It's not a clever strategy, but in 2026, it's genuinely the lowest risk one available to you. So, wait for your pre-fill before you lodge, get your work from home records genuinely in order, take extra care if you've got a rental property, and know what's actually changed versus what's still a year away. Small things, but they're exactly the small things that separate a smooth tax return from one that comes back with a "please explain." Quick reminder, I'm not your accountant. This is general information, not personal advice. If your return has any real complexity this year, a registered tax agent is a genuinely good investment, not just an expense. If this helped, hit subscribe. I break down every ATO update before tax time catches you out. See you in the next one.